Thanks for joining us, everybody. Welcome to Morningstar Investment Management's quarterly webinar series. In this particular webinar, we're joined by Jodie Fitzgerald, Head of Institutional Portfolio Management for Morningstar Investment Management. For those of you who don't know me, my name is Peter Burns. I'm the State Manager in New South Wales, South Australia and Tassie. Today, what we're looking to do is do a little bit of an investigation into the interrelationship between price and value. Before we get into it, I just want to let you know that in the bottom of your screen, you've got a Q&A box. That Q&A box will allow you to ask questions. So as Jodie goes through the presentation, please feel free to click on that Q&A box, type your question in, and we'll deal with them at the end. So in the intro slide, we've got a Warren Buffett quote there, and he put it in a letter to some of his investors a number of years ago. And it was taught to him by Ben Graham, who was his mentor and lecturer. And it is, price is what you pay, value is what you get. And this can be applied both to stocks that you might want to purchase or the socks that you actually need to buy. I like to buy quality merchandise which is marked down. So for the next 30 minutes, Jodie is going to take us through how to evaluate price to ensure we maximise value. How can we use this valuation framework to minimise losses and produce superior long-term returns? Along the way, Jodie will pause to give you some real-world examples of how we've applied these principles in the Morningstar portfolios. So I'm going to quickly refer to the disclaimer and basically remind you that the information in this presentation is of a general nature. We do not consider any of the personal circumstances of individual investors. So with having said that, I'm going to hand it over to Jodie.
Thanks, Peter. So we just moved to the first slide. I think probably the best way to think about and articulate Warren Buffett's quote that, price is what you pay, value is what you get. Just think about this in a real world example, right? So you've got a phone. You've decided you want to go and purchase a phone. You know exactly what you want, so you start checking out a number of websites. You'll note that retailer A is selling the phone for $1,050. Retailer B is selling the phone for $1,150. So what's the difference? Is the quality of the phone better at retailer B than it is for retailer A? Well, it can't be the case. It's the same phone, so we know that. So what you'll see here is that basically you could buy the phone of the same quality but actually pay a different price for it. So the only difference at retailer B is that it's $100 more. If you buy the phone from retailer B, the reality is you still have a phone that is only truly worth $1,050. So a similar thing actually happens every day, Peter, on the stock market, where basically if you were to check in with the stock market on a daily basis, you'll see that the price of companies have changed. Now, we know that the quality of those companies haven't changed on a daily basis. And in fact, the prices change minute by minute. Quality is certainly not changing minute by minute. So really understanding the difference between price and value is important in understanding what you should truly pay for any asset or stock that you're looking to invest in. So if we move down to the next slide and think about, well, what is value? Realistically, there are three types of value that investors really should know about. So the first is relative value. So let's go back to our phone example. In this example, basically, sorry, Helena, sorry, stay on this slide, sorry, but somebody else controlling the slides remotely for me. If you think about relative value and we think through our phone example, so rather than just saying that is the phone that I want and I'm going to try to find the best price, you could actually make a decision that, well, actually, I know the characteristics and the features that I want my phone to have. And you could look at phones from different manufacturers that are configured roughly similarly and have a look at the price and make a determination of which one is offering you the better relative value. So the price for the features. We can do this quite frequently in asset markets, and particularly let's use the stock market as an example. If you were to compare stocks So let's just say we take a country like the US and we're having a look at the consumer staple stocks available in the US. You could actually have a look at a ratio, whether let's just say PE ratio of all the stocks in that industry and determine from a relative value perspective which one is actually cheaper. Intrinsic value, this is basically the valuation of trying to determine what a company or an asset is truly worth based on its fundamental features. I'm going to come back to this one in a moment because from our perspective, this is actually the most important measure of value. The third one is perceived value. Now, this actually is probably the most dangerous form of value that we see in the market. Perceived value is basically, what does somebody think the value of that stock worth? It's in their mind's eye. Beauty is in the eye of the beholder, as they often say. And to give you a real life example with this, it's think about, we've all cleaned out the garage and put something on Gumtree or eBay to get rid of it. So let's just say that you, as a kid, had a BMX bike, loved that bike, but it's just a rusty old piece of junk sitting in the garage now. If you were to put that bike on eBay and not put a price on it, so the price that you ultimately get depends on the people bidding for it and what they're willing to pay. Now, to me, to you, to a lot of people, it's probably worth 20 bucks, right? However, if you have a BMX enthusiast who sees that and it's actually a bike that will complete their collection, they are willing to pay a lot for that bike because to them, the value of that bike is a lot higher than the underlying fundamental parts of that particular bike. Now, if you're lucky enough to have 2 or 3 people who are BMX bike enthusiasts, you can get into a bit of a bidding war for that particular bike. So perceived value is often used in the market to value, I guess, growth stocks is probably the best example. So stocks where the true value of that asset is based on, where you're trying to make an assumption effectively on what the future cash flows of that business will be. And there's no historical valuation that you can actually use to give you that firm understanding.
So if you were to go back to intrinsic value,
yep,
which you've stated was what we consider to be the most important of the 3, what are the fundamental features that what's fundamental?
Fundamentals?
Yeah.
Fundamentals. So if we move to the next slide, please. Okay, so fundamentals, what we're really looking for is what is the evidence of the true value of a particular asset. So as an example, I'm going to use the US stock market. If you have a look at the US stock market, so this graph goes back to 1871 through to 2019, so a ridiculously long time. But what I'm going to show you now is why the market is often referred to as efficient. So over this time frame, the total return from US stocks was 9.1%. So what drove those returns? And these are the fundamentals that we're going to talk about now. So the first thing that drove those returns, if we click through, is inflation. So inflation was 2.1%. Now, most companies can actually pass through inflation increases in the end pricing of their products. So what you'll find is that stocks tend to keep pace with inflation. So the next element is actually the cash flows. So what we're looking at here is the dividends and the buyback. So effectively, what are the cash flows that the stock market is actually throwing off? So a company can return cash to its investors through the payment of dividend or by buying back the stocks. And that actually accounted for 4.9%. So the nominal cash flows, so dividends and buybacks plus inflation, you can see actually account for quite a bit of the market return. The final component is the growth of those cash flows, which accounted for 1.9%. So the ability of a company to improve how it generates those cash flows and grow those cash flows over time. So what you can see there is that the fundamentals, so the known cash flows and the growth of those cash flows actually account for 8.8% of the total return. So when we're talking intrinsic value and we're talking, let's focus on the fundamentals, essentially an asset is worth the cash flows that it can generate and the growth of those cash flows, as simple as that. So fundamentally, that's what we focus on. What are the cash flows? How could those cash flows change over time? So to give you a better understanding of this and to conceptualize it and why perceived value is often considered a little bit dangerous in the market. So let's take an example, and apologise to anyone who's seen me use this example before, but I actually think it's a really great example of Uber versus the corner store. So Uber, 10-year-old company, It listed back in 2019. Now, the blue line actually shows you the market capitalisation, the share price, and that stock today has a market capitalisation of $64 billion. So if I wanted to buy Uber today, I would have to hand over $64 billion to acquire that company. The green line shows you the EBITDA margin of that company. So basically a measure of its profitability. And as you can see, it's negative. It's a 10-year-old company that has never made a profit, but to buy it, I have to pay $64 billion. Let's think about that in context of I'd like to buy a local business and I'm looking at my corner shop. Would I pay a large price to buy that corner shop if it had been there for 10 years and never made money? For me to do that, I would actually have to have a very strong perception of how I think I can change that business, on how the fortunes of this business is actually going to change relative to what's happened in the last 10 years. So you can see there is that with Uber, a valuation-based manager like us, will avoid those opportunities because there's no fundamental basis for the valuation of that company. There is a perceived value, though, to some people, and their perception of Uber to actually generate profit into the future. For us, as an investor, we often say that we operate in the world of probabilities, and we can tilt the probabilities in our favour if we actually focus on the knowns, and the knowns in this instance are the known cash flows. So if we move to the next slide, so you can see why we think that intrinsic value or fundamental value, as it's often also called, is really important. But the reality is the market actually moves away from fundamental values over time. This chart here was produced by Nobel Prize winner Robert Shiller, and he designed what was referred to as a clairvoyant valuation. So imagine that you know what all the future dividends are of the market that were going to be actually paid out. Take those, take those at a 10-year growth rate, discount it back, and that should give you the valuation of the stock market. And that's the purple line. The blue line is actually what it did. So what you can see here is that markets do move away from fundamentals over time. So what makes difficult there is the reality of, if we know that markets move away from fundamentals, how do we know what price to pay? How do we know that we're paying the right price for a company based on its quality? So the whole reason why I'm showing you this slide is to really highlight that intrinsic value, we believe, is certainly the most important valuation measure. But because stocks trade away from their fundamental value over time, it's really important to understand what margin of safety is. So basically, margin of safety and intrinsic value go hand in hand, or at least it should when it comes to value investing.
So define for me a margin of safety, and I guess, why is it important?
Yep. Okay.
You said they go hand in hand.
Absolutely.
So yeah, just walk us through that.
Okay, so if we move to the next slide. So a margin of safety, so we know that basically, what we're focusing on is an asset is pretty much worth the cash flows it can generate and the growth of those cash flows over time. Fundamentals can change though. So a particular industry, so let's just say we're looking at a company in a particular industry, that industry may be disrupted. There could be changes to the regulation associated with that industry. You may get an economic shock that impacts that more than other assets, etc. So fundamentals do change over time. So we need a margin of safety to actually sort of take that into account. Things may not go to plan. The value of that stock, or the fundamental value of that stock, may change from the time we purchase it over the next 5, 10 years, etc. Basically, the margin of safety that you're going to require is really going to depend on the asset yourself that you're buying and the probable variation of its future intrinsic value. So if we take 2 examples, let's take the bond market, for example. So if I'm looking at a bond, the future cash flows are known, right? It's the coupon that's actually going to be paid. What's unknown is the interest rate that you discount those back at. So the margin of safety you're going to require for that investment is probably a lot lower, because there's a lot less that can change into the future, versus equity that's actually been issued by the exact same company. So you've got one company issues bond, issues equity. There's less variation in the probable outcomes of the bond than there is over the equity, because there's more sort of tangible sort of changes that can actually occur within that particular company that could impact its share price. So basically, the margin of safety really depends on the probability of the variation of outcomes that you can experience over time. The greater the uncertainty, the larger the margin of safety that you actually need. Warren Buffett often referred to this as essentially buying $1 worth of assets for 50 cents. So the reason why that's actually important, if we move to the next slide, is margin of safety. Having a margin of safety helps to limit drawdowns. Now, this is a super important slide because a lot of people tend to forget the power of negative compounding. Compounding is a wonderful thing, but negative compounding is actually more impactful on wealth generation than positive compounding. If we take, for example, on the right-hand side, let's just assume that the markets draw down by 50% tomorrow. To actually get back to square, you're going to have to make 100%, and preferably without taking additional risk. So you can see that avoiding losses in assets is important for long-term wealth generation. So when you buy an asset, you spend a lot of time understanding that asset, its fundamental value. You know that it's currently trading below its fundamental value. You still want a margin of safety because that fundamental value can change over time. So you want to limit any drawdowns that may be associated with changes to the fundamentals of that underlying asset. So if we move on to the next slide. So I think what, again, is really important to sort of think through from this perspective is that, so even though it's important to avoid drawdowns, we can't avoid them altogether. We just can't, right? They're a natural part of investing. But what's really important for investors to actually understand is that not all drawdowns are actually created equal. So some losses are actually a permanent loss of capital, others are temporary. So understanding the difference between those two and how to respond to different drawdowns is actually really important. So a permanent loss of capital really is a function of valuation, fundamentals, and behaviour in general. So in this instance, usually you're more at risk of permanently losing capital if you've overpaid for an asset. So if I've actually bought an asset that's true value is $100, but I paid $200 for it, for me to actually not lose capital, I need to find somebody else willing to buy that asset off me for $200. Even though everyone knows it's only worth 100. Or to make a profit, I need to get someone to buy it off me for 201. So using perceived value, overpaying for an asset puts you more at risk of a permanent loss of capital because eventually the musical chairs stop and people stop overpaying for that particular asset. A temporary loss, on the other hand, they're actually just associated with the general volatility of investing in the stock market. Temporary losses are not something to be worried about, because they only become permanent when investor behavioural biases cause them to actually sell out of that asset and lock in those losses. So for us, stock market volatility is generally associated with investment risk, but to a shrewd investor, you can actually lean into volatility and unlock deep value opportunities.
So what we're really sort of indicating here is that some drawdowns are okay, particularly if they're short-term drawdowns, and can actually present investment opportunities.
Absolutely.
Yeah.
Yeah, and the recent COVID crisis is a great example of that, right? The markets fell hard and fast, but they didn't fall equally. So some sectors were completely decimated. Others, stayed relatively well afloat during that period. So again, as an investor, if you are focused on the fundamentals and if you've got a reasonable understanding of the true value of an asset, you see that that asset is trading below its intrinsic value. But, it's COVID, things are still uncertain, so that fundamental value may change a bit through time. I want a margin of safety, so I'm not going to buy it for its, I want to buy it for even less than that. Then that puts you in a much better position to withstand that. And I think sort of maybe if we move to the left side, sort of unpacking these differences in the drawdowns is really important. What I've actually got here on the screen is, what we see as the potential drawdown of global equity sectors. Okay, so there's two types of drawdowns, and they're distinguished by the two different colours that we have there. So the first, the green one, is a valuation-based drawdown. So what I actually mean by that is is an asset trading above its intrinsic value or below its intrinsic value? What you'll note in this particular slide that there are actually only two sectors, being energy and financials, where the green bar is above zero. So in other words, they're the only asset classes where we actually believe that they're trading below fair value. In other instances, if you take IT, for example, you'll see that the green bar is negative. We see these as being overvalued. So people are basically paying $200 for $100 worth of value in the asset. When you actually get a mean reversion in these assets, the losses can be quite substantial. These are the losses you want to avoid. So in the case of IT, the losses could be in the magnitude of close to 30%. So in this sector, we're talking about all the FANGs and so forth that have done really, really well. If you've overpaid for an asset, finding somebody else to also buy that asset off you at a further overvalued price is quite difficult. The second volatility that you'll see, which is the blue line, or the blue part of the bar, this is the volatility that is actually associated, what we refer to as core volatility, or effectively it's the cash flow induced volatility of an asset class. So some assets, all assets, as I've mentioned before, the value of an asset is its cash flow and the growth of those cash flows over time. Now those cash flows vary over time with an economic cycle. Some sectors are more prone to cash flow volatility and are more aligned with the economic cycle than others. So for example, what you'll see here is that the blue bar, the blue segment of that bar, is a lot bigger for areas like energy and materials and so forth. However, it's a lot smaller for things like consumer staples, because even if you are in an economic recession, people are still going to actually buy food, do their grocery shopping, etc. So this cash flow induced volatility is actually okay. It presents opportunities. And what we're really talking about here is time frame, short term versus long term. So if we flick to the next slide, the reason why core volatility is not a concern to us is it's a matter of time frame. So this shows you the Australian share market and the likely range of returns over time. So we know for a volatile asset over any given 12-month period, the range of outcomes can be quite wide. But the further out that you look, the more compressed those range of outcomes actually become. What we find is that core volatility or cash flow induced volatility basically dissipates over the longer term. So when you get volatility in the market, it can actually serve investors very well, because that core volatility means that these assets are now cheaper for you to actually buy. You can buy them with a greater degree of margin of safety. And assuming that you've done your research correctly and you hold on to those assets over the longer term, any short-term losses are not necessarily an issue at all for investors.
Okay, so in recent times, and I'm talking here through March in particular, we took advantage of a dramatic fall in the price of oil.
Yeah.
It presented a real valuation opportunity in a short-term sense. I want you to unpack this, because a lot of people, I think, have come to the conclusion that oil is yesterday's hero, that carbon-based fuel sources are sort of going to be challenged going forward. Obviously, transport around the globe at the moment is heavily impacted. Yet we saw this as a real value opportunity. Unpack it for us.
Yeah, sure. So there's a lot in that.
There is a lot.
So let's address them a handful at a time. So if we move maybe to the next slide, where I've got a chart here that shows you. So before we're talking about, as an investor, you want to buy an asset that is trading below its intrinsic value with a margin of safety, just in case things don't go to plan. Okay. Ultimately, if you do that over the long term, you'll build wealth. In the short term, though, you can still see volatility in the asset that you've purchased because of the cash flow volatility. Now, the COVID sell-off actually threw a lot of these opportunities up. Okay, and energy is probably the best example. So energy prices lost more than 50% of their value. In some instances, there's some energy stocks out there that you'd be able to pick up at 2003 prices, bargain basically. And that's for a number of reasons, right? For the fact that people aren't travelling, that people have assumed that these COVID-related lockdowns are going to be a permanent part, that they'll never get back to flying. There was also the OPEC plus, so there was supply and demand issues around this. But then you touched on, I guess, the ESG factor, so that people think that eventually oil won't necessarily be used as a major sort of source for getting around. I think for that last part, what you'll find is a lot of the energy companies are going to be a part of that solution. So the question becomes, does that mean the company's no good, or the company actually has to reinvent itself? That is also probably a long way down the track as well. From our perspective, the large integrated oil players are really sort of well positioned for that. Now, when we're valuing these positions, we're extremely conservative. So we've assumed very, very low oil prices. We've assumed sort of disruption to shale and so forth. We've assumed that eventually we move away from these carbon-based sources of energy. Even with that, the level of sell-off that we actually saw was so large that it presents such a good valuation opportunity. And as you can see here on the chart shows you that the MSCI, which is the yellow line, how it tracked over this period versus energy. And what you'll note, if you have a look at the energy, so it's still tracking downwards, like it's gone up and it's gone down, it hasn't recovered or stabilised. So in our portfolios at the moment, probably one of the detractors that we're feeling in the portfolio is actually energy, although it depends on the day that you look at it, because it's very, very volatile. We're experiencing a high level of volatility, but it's core volatility. And we know that the fundamentals, even with very conservative assumptions, still stack up for a risk-adjusted return over the long term. What's important as a valuation investor is understanding, is this a permanent impairment of capital? Have we got it wrong? Are these companies likely to sort of be completely replaced because they're carbon-based businesses? Versus this is actually just the market reacting to the short-term news around the cash flow generation of these businesses.
So confidence in those purchases remains.
Absolutely. And one of the things that's really important if you're going to apply this approach to investing is that so volatility provides opportunities to investors. And as a valuation-based investor, we're willing to lean into that volatility. So in the short term, you can get some uncomfortable performance outcomes. But over the longer term, we know it will build wealth for our clients effectively. But what's really important is actually having the cash to deploy into these opportunities, right? So leading into this crisis, you'll note that a lot of our funds held high cash levels. So we had the cash available to take advantage of the volatility. That's something that it's not an easy thing as an investor to sit there and see something falling and look through the short-term noise and see the opportunity and to actually have the assets available to deploy into that particular opportunity.
Okay, that's a great explanation. Thank you. So let's change focus for a minute. One of the things that Morningstar, I think, does really well is introduce behaviour and behavioural finance, science into the way markets operate and investors make decisions. So let's talk about the end investor for a minute. And we often mention that investor behaviour often gets in the way of their long-term performance. Have we got any evidence to sort of support that?
Yeah, absolutely. So on the next slide, we have the Delbar study. So this is a very well-known study. And what it actually does is takes a look at the interaction of investors. So what is the average return of the investor in the market versus the market itself? And I've put two timeframes up here, the 1 year and the 10 year. And as you'll see, the investor does more poorly than the market in both the short term and over the long term. So what this study really shows you is that in some respects, it's not what the investors invested in that's impacted their result, but it's the way they've interacted with those investments. Which is why I think it's important that I've actually spent time explaining to you that in these volatile market conditions, good opportunities come up. Understanding the difference between a valuation-induced drawdown, which would lead to a permanent loss of capital, in other words, I used perceived value instead of intrinsic value. I overpaid for it. Now I can't find somebody who's willing to buy the asset off me at a stupid price. Versus, actually, this is just the normal volatility associated with investing in an asset like energy, which is a high beta asset. It's cyclical in nature. It will have volatility. If you don't understand those differences and you've gone out and you've bought energy and you see, the volatility and it's gone down by a bit today and you freak out and you sell out, you start locking in those losses, etc. So it's not easy being a valuation-driven investor, particularly during volatile markets, and you've got to be made of stern stuff to be actually able to say, no, we've done the work. We know that there's actual value here. The risk-adjusted outcome over long term is going to be favourable for our clients, and to actually lean into that. Because what we're talking about here is really timeframes. So if we move to the next slide, drawdowns is a matter of timeframes. Okay, so particularly using energy as our example, is that we know we've bought an asset which is cyclical in nature, has a high beta exposure. We will experience short-term volatilities. There will be volatility that it is creating in the portfolio. What it also means is that we're not willing to buy those stocks that are getting that really big P expansion. So the FANGs is the obvious example. So at the moment, the market is euphoric on the FANGs. They're not actually looking for value. Once they turn their attention to value, obviously those energy positions will do quite well. But that's a short term. It's a matter of time frames. When you look out over the long term, if you've bought a company with stable earnings and cash flow, it's a sound business, and you've purchased it with a margin of safety, you'll get the long-term results that you're looking for your clients.
So is it fair to say that we've added a little bit of sort of increased cyclical exposure into the portfolios by buying into energy, and therefore the advisors should be kind of advising clients to just expect a little bit more volatility in the performance?
Absolutely. And we have financials in there as well, right? So another cyclical. So the two areas that were really sold off during the coronavirus was energy, but then also financials, because of the concern with regards to how the financials may be impacted by bad loans, bad debt, by the fact that sort of central banks were going to be implementing sort of QE and monetary policy that would make the yield curve flat. It's very difficult for banks to make money with a flat yield curve environment. Again, they're cyclical, they're higher beta exposures, so you will get more volatility in them.
Yeah.
But we've picked these assets up at really low prices. So going back to Warren Buffett's, I want to buy quality merchandise at a discount. It's exactly what we've done. But it's probably the first time in a really long time that we've had such a large cyclical exposure in the portfolio. So that performance variation is probably feeling a little bit different to people at the moment. Hence why it's important to distinguish between drawdowns that are valuation-induced, permanent loss of capital, versus drawdowns that are just cash flow induced, associated with the cycle, and we know that they dissipate over time. So it's a matter of time frames.
And so I think for the advisor, and the message they should be giving to their clients is, while you can expect a little bit more volatility in the performance of our portfolios, the confidence that we have in the positions we've taken is still very high.
Absolutely.
And we'll be sticking with those energy and financial positions. Great.
So remembering we've picked these positions up as they've fallen, and we've picked them up with a margin of safety to where we think their fair value is.
Yeah. All right, that's great. So it is a long-term game, and that's very much what we're playing. Valuation as an investment style has been questioned in recent times. We have been in a very momentum-driven marketplace where growth investing seems to be the flavour at the moment. The area that's I guess performing a little bit better than value. What are we thinking about that kind of outcome at the moment? Would you ever change? No.
Answer that too quickly? No,
yeah.
Absolutely not. No, well, we know that there is a lot of research that shows that value adds value. Value is the best way to generate long-term wealth over the long term. And even though value's had a tough time, again, appreciating we're valuation driven, not just, straight value for value's sake, right? It needs to be quality, needs to have a margin of safety. It needs to have fundamentals that we can see, that we can sort of hang our hat on. If we move to the next slide, so despite the fact that value investing has actually been out of favour for quite some time, we've still performed well using that approach.
Yeah.
So again, buying assets with a margin of safety and understanding what drawdown, when you need to sort of act on a drawdown and when you don't, is super important. So you'll see here the blue line is our real return growth fund and the green line is the peer group average. And over time, we have outperformed. What's super important there to note, we talked earlier about negative compounding and its impact on wealth generation. And you'll see during that sort of initial sell-off that we certainly didn't fall as much as others. So even though we're experiencing volatility at the moment, it's short-term volatility associated with those cash flows. So over the 10-year periods, I've got the upside and downside capture ratios there. So basically what that's telling you is that at any given point in time, if the market's up, 1%, we capture 76% of that. So we're not going to keep pace with those funds that are up to their eyeballs in growth momentum-led companies. We're only capturing 76% of that upside. But importantly, we're only capturing 61% of the downside. So that actually leads to quite a strong capture ratio, hence why we've been able to deliver this result for clients. And just sort of further, if we move to the next slide on the, is value dead? There has been a lot of articles written about it, and I think a lot of people have kind of dismissed it. What we know is that there is a lot of historic evidence, academic evidence that value investing is a proven strategy over the long term. But I do appreciate that value investing may not feel attractive in rising markets. Because it's really hard to stay disciplined when you see Netflix and Amazon going through the roof, but you just can't justify the valuation. There's a perceived value, the intrinsic value just isn't there effectively.
It's this behavioural FOMO type.
Absolutely.
Yeah.
Absolutely. So the discipline associated with that is actually really, really hard. But, as I've said, when you actually are investing, we operate in the world of probabilities. So we don't know what the true fundamental value of a company will be in 10 years' time. We can do some really good assessments around it based on the known cash flows, how we think those cash flows will grow, etc. But there's a range of outcomes that could be probable. Because we operate in the world of probabilities, what you want to do as an investor is increase the probability of success. How do I stack the probabilities in my favour? The way to do that is to actually invest via fundamentals. The known cash flows, what you can see, what is tangible, and to buy those known cash flows with a margin of safety. So it's our Uber corner shop example, effectively. If you do that, you start to stack the probabilities of success in your favour. And, if you were using perceived value, the outcomes are less certain. Right? So you're making a perception of, so this corner shop that I've bought, I have a perception, or I'm fairly certain that a really big development is going to be built around it. And, so you're making all these assumptions about what could happen or what might happen that would eventually improve the fortunes of that corner shop. So the probability of outcomes is a lot wider in that particular example. And if you think, and to use a live example, actually, if we move to the next slide, if you're somebody who's been using sort of a perception of a value and buying sort of those growth stocks, momentum-driven stocks, it requires predictions about the future, because these stocks don't have, the history is not going to be their future. And these are good businesses. It's certainly not saying that they're not good businesses. They are. However, how do we know what their future valuation is going to be, given that we don't have that historical reference point to actually relate to? Now, if you're an investor and you actually purchased Facebook back in 2014, which is the blue line, you've done very well, and good luck, fantastic. That's really great. However, when you made the decision to buy Facebook, you could have easily bought Twitter, GoPro. But the outcome isn't as nice there, obviously. So again, as a value investor, we're basically just saying that we are going to invest where the probabilities increase in our favour, do it with a margin of safety, understand the difference in the drawdowns that are happening in the market, which ones we should act on, which ones we shouldn't. And we'll always make sure that when assets are overvalued, we've got a large pile of cash available to deploy and lean into that volatility. And, as people like Warren Buffett and so forth would attest to, is that a shrewd investor can actually do really well in times of market volatility.
Yeah.
Set themselves up quite perfectly.
All right. Well, I think that brings us to the end of this particular presentation. Now, Helena, are you on the line there?
I do. We've got some questions. Shall I read them out?
Could you please?
Yeah. With governments propping up economies and therefore share markets, do you think this could have long-term impacts on value investing?
Look, it can, and it has really in the last 10 years. But if we go back to 3 slides earlier, we've still managed to do better than the peer group over that time frame. I think the difficult part about the go forward state at this point is that with central banks and quantitative easing and so forth, is that interest rates are really low. So the interest rate that you then use to determine your valuation is quite low, effectively. So the conversation that I think we need to be having with clients on a go forward basis is actually around return expectations going forward. These frothy, phenomenal returns that we've actually seen out of some equity markets, they're just not realistic long term, essentially. So I think that's sort of really key. But no, value isn't dead, because at the end of the day, as I said, any asset is going to be worth the cash flows that it can generate, the growth of those cash flows. And a lot of companies, the stability of those cash flows. So how stable are some of the cash flows in companies that are actually being propped up by sort of inefficient, well, not inefficient, that's probably the wrong word, but by artificial policies and so forth.
Yeah. Do we ever consider in our processes how much dry powder do reserve banks and governments have left?
Well, so that's an interesting one, right? If anyone's sort of familiar with the modern monetary theory, is that basically, theoretically, a sovereign government
just prints,
right? Can't go broke. So as long as it's issuing debt in its own currency, so theoretically, the Australian government, as long as it's issuing debt in Aussie dollars to pay that off, they can't go broke. It's not like a household budget where I don't have enough money to pay it off. The government can just print the money. Where it becomes problematic, though, is that at some point, if there's spare capacity in the economy, that's fine. It won't cause inflation. Once you hit up against and reduce that spare capacity, it becomes an inflationary problem. Now, this is one of the great ways that countries have historically reduced their debt levels. They've inflated their way out of it. So the question becomes whether or not it's going to be effective going forward. So is there a limit to it? Well, there's a limit to the effectiveness. So we're finding with each round, the rounds have to be bigger and bigger, and the impact on the markets is not quite the same each time. And on a go-forward basis, fiscal policy is going to need to do heavy lifting. Again, that provides opportunities, right? So if fiscal policy, that's usually government spending, infrastructure, a whole bunch of different projects. Who are the beneficiaries of that? Is it Netflix? Or is it transport companies? Is it other areas of the economy? So in some respects, I don't necessarily think central bank policy will unwind quickly. I don't think it's able to at this point in time, but it's the other policy levers that will come into play that will probably refocus the market on where true value is in the market itself.
Helena?
Hi. Yes, we've got a few more. I will say, as we come to time, any questions that are unanswered, we'll get back to you today. CPD points, yes, we'll be distributing them shortly. One other, there's quite a few more. One here is, Is Facebook an example of where the fundamentals have changed, yet Twitter's in the same industry and failed, or is Twitter now a good option based on value?
Well, you again, so it all comes down, okay, so have the fundamentals of Facebook changed? Well, all these companies, their fundamentals are changing over time. I guess sort of the point I'm making with this slide is back in 2014, given the way that business model was evolving, could we, hand on heart, have a firm understanding of the cash flows that that business could generate over the coming 5-6 years and the growth of those cash flows? Probably not, because we'd have to make a lot of assumptions and a lot of guesses about how the business model was evolving, etc. Same with Twitter, same with GoFro. But if you use the current state and the current business model as an understanding, you could come up with a very different valuation to where it is actually today. Twitter, is that a good opportunity now? I don't know, to be perfectly honest with you. It's not something that we've looked into. But again, for us, it comes down to the cash flows of that particular business and what is their business model, how they're generating it through advertising, etc. Not sure I answered that very satisfyingly, but
Jodie, we'll do one last question. This is a good one. In the context of CPI objective portfolios, if rates stay lower for longer, what does that mean for clients?
and I think these are the conversations the industry as a whole are going to need to start to have with clients. So here's the reality. So around the world, interest rates are low, negative in some instances. CPI, granted, is low. That said, though, the bond market is actually pricing in inflation at the moment, which is quite interesting. CPI plus objectives and achieving them is getting harder, quite frankly, particularly if you think about the fact that the market is overvalued at this point in time. We went back and had a look at the drawdown bars. I said there was energy and financials are trading below fair value. Everything else is looking expensive, some more so than others. So that should mean on a go-forward basis, if they mean revert, you'll see some losses. On top of that, interest rates are low, etc. So CPI plus objectives is getting hard, particularly for defensive investors. So for those investors that are predominantly in fixed income and so forth, actually achieving those objectives is some of those objectives may be compromised over the short term, and they're conversations that we're going to need to start to have with clients. And I think what's really important is ensuring that you don't increase the risk profile to generate those. And I've had conversations with investors and people in the industry where that's happening, where people are moving into higher yielding bond parts of the market, etc., just to generate that additional return, or going into sort of the overvalued stocks because the headline number's looking really great, but what happens when that actually mean reverts, because we know it's on perceived value.
Just on this, just to finish up, I've been asked on 4 or 5 occasions in the last 2 weeks by advisors this idea of where do I generate income out of a portfolio for retirees?
Yep.
It keeps coming up. Do you want to comment just on that as a concept?
Yeah.
Because it relates very much to what you've just said.
Yeah, look, I was actually asked this question last week on a panel that I was on, and my response was, who cares? I know that sounds really sort of dismissive, but the reality is, historically, the industry has built portfolios for retirees with a combination of TDs, when TDs were paying nicely, and some dividend yielding stocks, right? Put those two together, away you go, you've got your income generation. The reality is, I think we've incorrectly focused in on income here. What's retirement all about? Retirement's not about income, it's about cash flow management. Can I manage the cash flows of my client in retirement? Now, unless you have clients who are completely overfunded, got heaps of money, and they can sit there and live off the dividends, that's great. The harsh reality is most clients are going to have to draw down on their capital. In retirement, you're in a tax-effective environment. So you therefore should be agnostic to whether or not you are managing your cash flows from income or for capital. So my concern with this consistent focus on yield for retirees is, well, what price does it come at?
Yeah.
So the one thing that we learnt during the COVID crisis was that, well, not learnt, we knew, but it was really evident, is that dividends are actually not guaranteed or
Look at the
risk-free,
banks.
right? So globally, there's been a trend to cutting dividends or suspending them. Now, if you've put a client in a stock and you've overpaid for that stock to start with, but you didn't care because you're getting a decent yield, and that yield has now been compromised, and sorry, but the share price has also fallen by 20, 30%. It's not a great outcome for retirees. So by focusing on yield, you could actually introduce a sequencing risk problem because you're actually buying overvalued assets. So my concern with the yield focus is people purchasing overvalued assets for that yield, and it just creates a whole new set of problems. You should be agnostic to where those cash flows come from, whether it is income or capital. Total return is what the focus should be for retirees.
And I think that's a great place to sort of wrap this up, because it ties back into that price is what you pay.
Absolutely.
That is what you get. So, all right, I think we can wrap it up there. Thank you, everybody, for attending. I hope you got some value out of it. Talk to you next time.
Thank you.